Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon, or you can go to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much talk about it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team at Kedrick today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thanks for being here today.
Welcome.
Yeah. David's going to be reading your questions, and I'm going to do my best to answer them. You can send your questions in by either texting them to 913-363-1234. Again, that number is 913-363-1234. Or you can email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, how do you plan around inflation risk?
Inflation risk is, in my opinion, a very real thing in the very near future.
Tell us, like some people might not know, like I've never heard that term. What's inflation risk?
Yeah, so let's first define inflation. Inflation is basically your money's less useful.
Right.
It's less powerful. And we saw inflation over the last couple of years. So I think everyone felt it, whether they can articulate it or not.
Right.
People felt it in their pocketbooks. When you look at inflation, you don't go backwards. Like what's happened has happened. And so the trick is you want to basically bridle inflation to be at a healthy rate, let's say around 2%. That's kind of the Fed's target rate is around 2% inflation. Fine, no big deal, right? Most people can handle that. Inflation risk is when things get out of hand. So my favorite case study is in the 70s. In the 70s, inflation got out of hand. Okay, there was credit issues, there was banking issues, there was all sorts of issues that basically fear in the economy, things that fueled basically hyperinflation. The Fed increased their interest rates to try and stomp it all out, and then inflation started coming back down, and then the Fed lowered rates, but they did it too soon because they were trying to be nice. And then they lowered rates too soon, and then it spiked back up again. And it was difficult for the economy, difficult for a lot of people. Fed increases rates again, and it starts to come down another time. This is now mid to late 70s. And then they lowered their rates thinking they solved it. And then it spiked back up again. It wasn't until Paul Volcker, the cigar smoking chairman, who got up and cranked up interest rates. For all of those, you bought your house in the 80s. It was miserable. It was miserable with those rates, but you remember it. So because of that, he's like the American version of the Iron Lady, Margaret Thatcher, right? Yeah. For England, but economically for us, he did the hard job. He did what was needed to do to get inflation under control and to keep it under control. Well, we might be in a similar situation because at some point, whether you like Doge or not, whether you like Trump or not, whether you like what's going on with our spending or not, whether you agree with our deficit or not, it doesn't matter politically what you think. Economically speaking, there comes a point where any government, when their debt increases, their credit is hurt. And if their credit is hurt, or if the deficit gets out of hand, or people lose confidence in the American dollar, whatever it might be, there comes to a point where monetary policy or monetary management, the printing of money, quantitative easing, all of that, there comes to a point where you really can't get out of it very easily, at least. And we saw many case studies of this of Argentina when they got way in over their head on spending and inflation. Zimbabwe is another, you can what is it, $1 trillion? Leighton, would you look up real quick what $1 trillion is in Zimbabwe money for American USD? $1 trillion is Zimbabwe money. That sounds like a lot of money, right?
Yeah, it's funny you should mention that because I was just watching a program, like a documentary program, where they were driving around like, look, I have $1 trillion bill right here.
Yeah, so Leighton,
that's where they were.
Leighton, our in-house producer, is going to look that up real quick. But inflation's a very real thing, and you can't control it. As much as we want to feel like we can control everything, there comes to be a tipping point where you can't control things. So there are different ways that we can get rid of our inflationary risk. Yeah, Leighton. $2.6 billion is $1 trillion of Zimbabwe money. Yeah, 2%. It's worthless currency. Zimbabwe is not a worthless country.
Right.
Their currency it's not worth what it could have been because inflation got a hold of it. So the point being here is inflation very well could be an issue again and again and again. It can rear its ugly head. Now let's kind of talk about ways to solve it. You can cut spending. You can cut the deficit. So the deficit, by the way, just means that you spend more than you make. Okay, that's the deficit. Deficit is not debt. That's a whole nother thing.
Yeah.
And as of this morning, I was reading some very fascinating analysis on our spending. If we can get back to 2019 spending, we're closer to a budget, basically a more balanced budget, and then we can start addressing the debt. But these are things that need to be addressed because we have something called mandatory spending. Mandatory spending is Social Security, it's Medicare, it's Medicaid, these things that we have to spend by law. And that's the largest part of our books. Another way is the United States government could issue a ton of debt at current rates that people would be willing to buy for. And by the way, the Treasury isn't controlled. They auction off the debt. So whatever the market's willing to pay is what they're going to pay on those rates.
Oh, right.
The Fed's interest rates that they set, that's overnight lending. That's not what the Treasury and offsetting the debt is. It's what the market's willing to pay for these debt instruments offered by the Treasury. And that's often misconstrued.
Right.
So the government could, in theory, issue a ton of debt, take care of kind of the issue for a temporary period of time, and then allow inflation just to run amok. And they've basically inflated away a lot of our debt because it was issued at a certain rate. It was taken care of. Now the money's worth less, and so they can pay it off easier. But it's worse for the American economy.
Right.
So right now we have a president who is trying to act like a CEO of a company, as the turnaround CEO. Hey, this isn't working. He's going to cut spending. He's going to try and leverage certain assets we have and try and get things in order. And Trump is someone that has used, or what some people will say abused, depends on how you view him, but he just uses bankruptcy law and other debt laws to his advantage.
Right.
Is he going to do that? Well, it's different. The government bankruptcy law is not really the same situation.
Yeah.
So we need to be prepared for potentially more inflation in the near future as he's trying to sort things out. And there's no guarantee that he'll be successful or not. So going back to other conversations we've had about annuities, if all of your assets are locked up into an annuity and you've turned on flat income, and let's say inflation got out of hand for a temporary period of time, that's going to mess you up because you have no negotiating power on your income stream at that point.
You get you're locked into a contract with the insurance company, right? And so you're only getting this much income. It doesn't raise, but yet your money's worth less. A
25-cent candy bar is now what, $1? How much does it cost to buy a Snickers? How much does it cost to buy eggs?
Oh, yeah.
Now imagine you're doing a 2012 spending plan with today's prices.
Right.
That's hard to do.
Yep.
So inflation is a very real risk. How do you combat it? The way you combat inflation is to focus on growth with your overall portfolio. If you have money in the market, whether it's in indexed products that have upside potential, or you're in an index, or you're in growth stocks or growth investments of any kind, then you're able to help offset inflation. If you go too heavy on cash and cash equivalents, maybe some of the bank products like CDs would be a cash equivalent, or you go into money markets, these lower earning accounts, because you fear that the market will crash. Maybe the market does crash. Maybe you solve that risk, but you're solving one risk or adjusting one risk and completely ignoring another risk.
The inflation risk.
Yeah. All retirees are fighting multiple fronts at the same time, which is why it's so important to have a comprehensive plan. You got to plan for multiple layers. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles, or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you, regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.